All right, I believe we got everybody set and ready to go. Once again, we are going to have another one of our roundtable discussions featuring Event Trader, Chart Trader, Blue Chip Trader, and Scalp Trader. And I will toss out some questions to them, and we'll interact and have a nice little discussion. The focus was going to be basically, now that we're about halfway through earnings season and we've had the Fed come out with their most recent update, where the trader's mindset is and what they've learned from the particular events that we've seen. And the first place I want to start is with Chart Trader, because I think that you had something pretty interesting, and I'd like you to elaborate a little bit as to what you thought was somewhat interesting about the yield curve actually flattening today. So just cue us in on what you're thinking and what that really does mean to you.
Yeah, sure. So, I mean, typically a flattening yield curve is either the suggestion of too tight monetary policy or a slowing economy. And a steepening yield curve is, obviously more of a reflationary kind of situation where the monetary policy is set so that it's conducive to growth, it's not overly hawkish, or the economy is just so robust that it's powering ahead. Yesterday, we got this sort of what I've been calling the have your cake and eat it too kind of Fed meeting where it looks like data is better than expected and the Fed is more dovish than expected. And you'd think that once that kind of is sealed into place, we would start to see a steepening yield curve, because I don't think that everything that happened yesterday was completely expected. I think that they hit on the dovish side of what was expected, and the data's hit on the better side of what's been expected, generally speaking. So the combination of the two would suggest a steepening yield curve. The fact that it's not steepening, it's barely flattening, it's basically even, just is a little bit of a hiccup there, and is interesting when you think in terms of, what's the bond market seeing right now? Why do we see the long end of the curve in terms of the bond prices so strong today? And that is just kind of a mystery and an interesting one and something to watch, because maybe the market is discounting that we're going to see a little bit lighter than expected economic data coming forward, and the market's starting to be able to sniff that out. So it's just something to keep an eye on. If we saw a big booming, steepening trade today, it would be much more comfortable for people who are chasing into equities right now. So it's just something to keep an eye on.
Have you speculated as to what might be going on outside of the potential for weakening economic data?
Well, I mean, one way to look at it is just the bond market is starting to see that, the next move by the Fed is actually going to be a cut. That would be another way to kind of look at the situation, that we are seeing a stagnating economic picture, at least for a while. And I mean, I'm not saying that's necessarily what's going to happen, but this would all be consistent with the idea of a kind of either a cycle pause or a cycle rollover, that the first stage is the Fed getting a little more dovish than you'd think, markets initially responding well, but then the economic data starts to sour a bit, and the bond market kind of seems to sniff it out a little bit in advance, and you see the long end of the curve really strengthen in price terms. So, I mean, that's the super early, super low conviction indication is in line with that kind of narrative. And it just, you've got to just kind of piece these things together over time. It's just put it in your pocket. We didn't see a blowout steepener trade today. That's important to know after we got that kind of have your cake and eat it too Fed yesterday. So, I wanted one to log, one to remember, one to kind of note. And then as we keep going forward, just, remember that as you get new information, that it comes in a context that's been kind of initially identified that way.
Hey, Brett, one thing I think that's important to add, that's going to add to the market confusion, and we talk a little bit about that weaker economic data. Right off the bat tomorrow, we get the BLS report, which is going to be impacted by the government shutdown. And, just to throw out to people, and I'd be curious your thoughts on how people should be treating economic data in the next couple of weeks, that is going to see a little bit of the idea of transitory impact from the government shutdown. How do you see that in terms of the market possibly reacting to some of these numbers?
So, what it reminds me of, and now you're not talking about data representation and data handling, you're talking about the actual economic impact of the shutdown.
Yeah, not talking about the handling,
So,
not talking the timing of reports. Obviously, they were
Right.
delayed, and we're going to be getting a lot coming up. But the BLS report for tomorrow, that's going to see an impact from the government shutdown. We saw for claims jumping 53,000 week over week because of the shutdown. So it's going to add a lot of confusion, I think, around the data points too. That's going to make it tough for the markets to react properly in both the short and medium term, I feel.
Yeah, so you know what it reminds me of a little bit? I think it was 2014, might have been 2015, but I think it was 2014, where we had such bad winter storms that, do you remember this? Where
Q1.
Yeah, what was that? 2014.
And I don't remember if it was 2000. I mean, we had a 3-year run. I felt like a Q1 data coming in weak because of storms.
Yes, but there was a particular year where it was more dramatic and more pronounced, and it turned out to be that the people making the argument that there was a pent-up effect ended up being right.
Right.
I think, we saw more robust economic activity after it was over. So it kind of, and especially, this would be especially the case if back pay will be given out for all the government workers, which I guess is the plan, right?
It is.
So, I mean, really, your consumption drops a lot during a certain period, then it rises way up in the following period, and it kind of all balances out in the end. And the market may already kind of have that figured out. So when we see weak data points that appear to be related to that, it probably won't have a whole lot of impact on how markets are trading because they'll realize it's just step one of a two-parter.
Right, and just a quick heads up, there's a headline crossing, just to keep markets in the background, that Trump saying a China trade deal says something will happen, so we'll keep an eye out on the reaction.
Did you see the note that I posted earlier? Not to jump topics, but I don't know if anybody saw that. I just feel like the way that he approached that tweet earlier today is a sense of saying, hey, I'm going to be really tough on these guys and make sure that we get this, agricultural purchases or something. Like basically trying to manage the process of keeping up appearances about not giving in, not taking a face-saving deal, making it look like China's really, really giving in to a really tough White House line, but shifting the target away from the telecom stuff and the IP stuff and focusing more and more on, open access to China's economy, things that are easier to get done, which would make me feel like it's part of a marketing agenda to try and sell the fact that the deal he thinks he's about to get is one that's good and worthwhile. I don't know if
I did see that. I completely agree with that.
Okay, yeah, because that seems to make it more likely that we're going to get a surprise announcement of something. I don't know whether it's right now. Maybe it's in a couple weeks, but it feels like if that's the move, then they're setting a baseline expectation to be able to really sell the idea that the deal they're getting is a good one.
The flip side of that argument is with the Fed pivot and the recent market move, does Trump feel emboldened to kind of press the issue?
That's a good point too, right? Yeah, right. It does seem to give him more latitude.
But
sorry, I totally changed the topic. Sorry about that.
No, and that's a key point that we definitely have to consider when we're, trying to decide what we want to do with markets. That these headlines are relevant, and you have to navigate through them like a slalom skier, I guess. But to, I guess, get back on point a little bit, we've had, I guess, the overall tone would be a fairly okay earnings season. As far as the performance of the stocks and whatnot, we've had some hiccups here and there, but a lot of the big names have produced, I guess, some less than fear type narratives, if you will. Now that we've kind of gotten halfway through, how are you approaching the markets? I'm looking at the VIX now below 17. Chart, you had highlighted a level in the put-call ratio that might get you interested about snuffing out a potential short. So we've got some dynamics that are unfolding. The market looks good. We've got this what do you call it? The panic of missing out type trade going on.
Yeah, right.
So
next gear.
And I'm watching Scalp Trader. He's been more active in day trading. So there's a lot of activity, and I'd love to just get all your guys' sense of how you're approaching the markets now.
Are you asking me first?
You can go first.
Okay, I mean, I said I wanted to see 2710 as my target for thinking that we'd see the panic of missing out process kind of unfold in that capper rally off the Fed. But honestly, what we're seeing from Trump so far this morning has made it very difficult for me to want to fade, because I would really much prefer fading following a pop, following the announcement of something where there is, I guess we just got something else from Trump saying, I'm doing historic things for U.S. manufacturing. It's kind of a drum beat is starting to maybe march up towards something of, trying to get this behind him. And if that's the case, I don't want to short in front of a headline like that, even if I think that there's a short right after it. I certainly want to be able to short in the aftermath of something like that. So if I feel like we're percolating something on trade, I don't want to fade in front of it, even though we're starting to get the levels I was looking for. So, yeah, I'd like to see a put call up under 0.6. That would be a nice little extra point. But so I put out a chart book yesterday evening, and I went over sentiment data in it. And one of the points that I came to was, we really aren't seeing anything that suggests exuberant sentiment data in the market at all. So it's still a situation where the fade you get is probably a tactical strike rather than a big serious bear position, and that the other side of it is probably almost more interesting, which is when you start to see fear come in on the downside on anything, that the buy there is probably even better. So that's where it looks like it's at right now, just given sentiment data. Obviously, the thing we talked about with the yield curve, if we are seeing the cycle hints at rolling over, if we've got some big tough data coming at us, that changes that picture. But without that, with the positioning picture, people are still trying to get long, and we may see a short-term burst off a headline that's a nice fade that we smack back down, maybe test 2,600. But if that gets a put call up to 130, the buy there is probably going to be more interesting. So I'm really in read and react mode right now, and I'm trying to figure out where these headlines are around China and if Trump is kind of lining up to market a deal. And if that's the case, then the other side of that headline pop will probably be a really fantastic fade. And then, looking to be kind of tactical with it and maybe get back on the long side.
All right, Gav, and you got short a little bit earlier today, and I know you had been leaning somewhat short on the market. I think we might have gotten a little hot. Are you still looking for an opportunistic point to short, or has your analysis actually changed?
Yeah, I was basically looking for an early morning rally and then for some profit taken to take place after that big pop on the Fed. I think I was a little too early. When we get up to 27.25, then we're back to trading about 16 times forward PE. We might even see some further downward revisions to some price earnings. So I thought that that might be enough to give a little bit of a pause for the market. But right now I just got it caught up a little bit trying to get involved in ahead of some animal spirits, I feel like. So I still am looking for a fade. And that's just more for a hedge than any sort of big market direction. I do think that there's some things that are going to play out here. Still, that the market's gotten a little bit ahead of itself. I talked about this back in October, or in late September, when I trimmed a bunch coming into before I left on vacation, and that was just kind of a confluence of things going on. And we got the China trade talks with on March 1 that we really haven't seen, or the decision on the trade tariffs on March 1 that we really haven't seen any big breakthrough that suggests we're going to kick it down the road. Chances are we probably will. But I can't imagine the Trump administration would just let it go without a little bit of 11th hour hand-wringing to see if they couldn't get further concessions out of China. And that's also going to be running up right against the debt ceiling, where we've already seen pretty much an early indication of how this Congress is going to act over the next 2 years, where it's going to be more or less full-out war to try to get anything to get done. We got the Brexit issue, which is certainly getting glossed over. Theresa May can't get this deal through her parliament, and we saw the EU kickback saying there's no chance that they're going to come back and redo any sort of deal with them. So I just think we've kind of gotten a little bit of price to perfection here, with some pretty significant headwinds laying above us that I just don't think the market's really priced in yet. So I'm not afraid to try to take a shot at a hedge here and there. And outside of that, I added a bunch to my portfolio over the last couple of weeks and just kind of letting that run on the side and trying to play the futures as my hedging for the up and down gyrations in the market. So, just a little bit early, I think, but at some point, I think this action's going to start to tail off a little bit. We're going to see a bit of a pullback as people readjust some of the dangers that were priced in probably a little too aggressively at the end of 2018 and now have been forgotten a little too quickly at the beginning of 2019.
Based on some of the things you guys have already highlighted, the jobs number tomorrow doesn't seem like it's going to be that big of a deal. Is that the correct way to think about it?
Yes.
Same with you, Chart?
Yeah, I suppose. Right. I mean, it depends if we see something remarkable like on wage growth, but
it comes down to, Brett, what I was talking about in terms of, we could see a huge drop off from 325 down to, I think the consensus is 160. And that's being halved, and yeah, hourly earnings certainly plays a key role. But we just saw from the Fed, which for my money was the bigger item, that inflation's not a concern. So I mean, if that inflation number comes in high, does all of a sudden Powell start coming out and saying, well, maybe inflation is a concern? I don't think that's walking back that quickly. So I think that the between the shutdown and the Fed, that this jobs number has been completely declined.
All right, so I'm going to bring in Damon now. And Damon, one thing that I've noticed is you've really ramped up your trading in just regular day trades, even more so than some of your swing trades. And you've gone on both sides. You've shorted AMD. You've kind of went short the. You bought the LABD, which is a short biotech ETF. So you've been playing both sides, but your activity level has really ramped up. What's going on? Where are you seeing the opportunities?
Well, first I guess I'd say I sacrificed my Christmas vacation in order to be here to take advantage of this just major sell-off. And, as I noted at the time, late December, we were just seeing just massive ETF outflows. And, I just thought the price action was overdone. That combination of ETF outflows as well as end-of-year tax loss selling just led to kind of a tsunami of selling across the board. And, December 24th was the bottom. And if you're there December 26th, which a lot of people weren't, you've made just monster gains over the first month, over the past month. And so what I'm seeing now is money is steadily flowing back into the market. You're getting the ETF inflows, which is pushing everything up. And so I've been taking profits on a lot of the positions that I bought in late December and early January, which has led me to start trading in some of the second tier and third tier names that I don't necessarily have a lot of conviction to own long term, but I know that we're kind of in a bull mode right now in terms of ETF and equity inflows, and a lot of that money is starting to make its way back into more speculative areas of the market. So, I might be buying something like a BLUEX, which is, it's definitely not a Facebook or an Apple. But I know that, kind of rising tide lifts all boats, and we're at that point. But at the same time, I'm also starting to position on the short side just in anticipation of some type of price shakeout. I mean, if you look at just how a lot of these stocks are running post-earnings, it really is staggering. Mediocre numbers, money flooding into these names. And I think you have a situation where you could get kind of money chasing stocks and people kind of get their legs kicked from under them. And so I'm starting to position on the short side while remaining agile on an intraday basis, both long and short. So in the second and third tier names, buying pullbacks like I did on the BLUEX this morning, just playing them for a bounce. And then when things start to get overextended, starting to position on the short side. So, for example, the biotech ETF is up over 15% year to date. So we're at the end of January. The index is up over 15%. So I'm starting to lean against biotechs a little bit, just looking for a little profit taking. And I think kind of once that begins, groups like biotech that have been extremely strong since the beginning of the year may be the first ones to shake out a little.
All right, so I have a bit of a tough question for you all, and it's going to enable me to bring in blue chip trader on this one. And the question, I guess, for you all is, how do you handle it when you guys have a particular idea and one, or maybe more than one, trader on the desk has an opposite idea? In this case, blue chip, I know there was a time in which I don't know if you're still long LABU. Are you? LABU?
No, LABD was the one I was going after.
Okay. Okay. So, well, there was one in which you were long. The Scalp was long one, and blue chip was long the other. You know what I'm talking about? So basically, in opposite positions in the biotech, your opinion of biotech was completely different at the exact same time. And I know this has happened between. Well, I mean, there'll be times where I'm sizing up a particular long in the S&P, and chart traders like, oh, I think I'm going short, and I'm like, oh man, that's like the last thing I want to hear. I want him to be on the same side as me, and I have to reevaluate. So how do you guys handle that when that happens? Because I know you have tremendous amount of respect for each other.
Yeah, it's definitely a tough thing to do on the site for sure, and we do run into it occasionally. I think the most recent one was probably AMD would be a great example. I think Tech T was advocating as a short yesterday. Scalp tried to short it as well. And technically, for me, you know, looking at a chart like AMD, this is a really strong stock breaking out. So I find it, as a technician, a little harder to swallow those as shorts. Now, you have to understand yourself as a trader. I mean, that's the key thing what it comes down to. Obviously, there's Tech T's time horizon is multi-month, and he scales into these types of positions based upon what he sees. Scalp trader is more of an intraday timer where he'll look just to play if he can get a quarter or 50 cent, you know, whatever his target was for that sort of scalp trade. He's looking at that time frame, where somebody like me, I would have went long something like AMD because it was breaking out above the last week's highs post earnings after, you know, a little false breakdown a day ahead of time. And that's more of a swing trading perspective, where I'm taking it from just looking to capitalize on the current momentum that's taking hold out of a consolidation pattern. So there's a lot of different analysis, and that's the beauty of the markets. There's no one method that says it's better than the other one. You just have to identify your edge that you see in your time frame and go with it. And it's not too common that you're going to see many of us, you know, go against each other in the same time frame. And maybe in the futures market, because that's really kind of a broader thing, and that moves the quickest out of anything. But when Scalp was going, I think he said he took a short, but he was shorting it for a day trade, and I was sitting long for the last 2 weeks as a swing trade. That's no harm, no foul. You know, you kind of have to take everything in context. It happens occasionally from time to time on the site, but again, like I said, that's the beauty of the markets. That's why the reason why stocks move and they go up and down is because of different of opinions. So. Yeah, I wouldn't read too deep into that if you see it on the site. Just take everything into context and understand where the approach is coming from. See if it fits your own comfort levels and risk parameters, and then either go with the trade or don't. By the way, it looks like Chart Trader, speaking, just went out there with a short in the S&P futures.
Yeah, you get your opportunity to talk about it real time here, Chart Trader.
Yeah, I mean, you know, I said that I was looking for 2690 to 2710. We got into that range, and I'm just watching the orders come through right now, and it just has me feeling like I'm starting to see some of the signals I was looking for. Just the character of the action, and given it's in the zone that I wanted, we got the put-call ratio down to about 0.7. That's all fine. So we start to see a little bit of a rollover, but I'm small and I'm wide at this point because I don't have that much in the pattern to go with. So I'm giving this plenty of room, and we'll just let it evolve, and this hopefully will give me a chance. It will break back under 2700, give me a kind of lateral range, and it will allow me to add to the position and tighten up the stop. So we'll let it evolve.
Inside target? Oh, I'm sorry.
I'm sorry. Go ahead.
Do you have an inside target on this one, Chart?
Inside target would probably be right around the 2650 area, perhaps. big, but again, consonant with the risk, and then looking for under 2,600 as the outside target. So a swing trade.
Okay.
Right, so just to let everyone know how I interpret that on the site. So I see Chart Trader go up here. It's midday. It's lunchtime. The market's been in a fairly strong momentum trend day up throughout the morning here. I look at the internals right now, and they've been tinkering with this potential trend day up, slight bullish range territory today. Same with the up-down volume ratio, just kind of grinding higher. But going into midday, ahead of a Fed meeting tomorrow, we have Amazon earnings. Thank you. We have job data tomorrow. We have Amazon earnings tonight, and Amazon just blew through that January high in the 200-day simple moving average right around that 1716, 1780 area, shot up to 1729. It's up $56. It's been grinding higher. It's a good chance Amazon, which is one of the heavyweight components in this market after a strong run-up, is probably going to start petering out here a little bit. And I don't know if he's looking for a giant correction of sorts, but when I see a post on the site here at midday with all these different things that I'm looking at in the market, that's something that I might, I don't trade futures too often, but maybe I want to go short or slap a hedge on in the QQQs at the same time. So I think that's the way I approach when I see traders on the site. You kind of have to read between the lines, between your own analysis, and not just blindly follow us on our posts. Sometimes things jive are going to jive, and sometimes things aren't. So I think it's a good trade here.
Hey, just real quick, because I know Damon was just asking me out. Not really seeing any headlines associated with this rollover. There's a few Trump tweets, but nothing that's really changed the narrative. Pretty much, or comments. It looks like he might be actually speaking somewhere. He did say he thinks China deal can be reached by March 1, but we're still not getting any details out of that. We've been hearing the idea of a trade deal getting done. So just wanted to throw that in. A quick question for Brett, because I know you were saying you were keying off of the S&P and using the NASDAQ as your vehicle. Is there any reason why you went with the S&P here?
Financials, relative weakness.
Good call. Which would obviously be based around the Fed on a pause right now. I think that's one of the primary reasons, and the flattening yield curve while financials have been dragging a little.
All right. As far as some of, if you were to give this a scorecard, a midterm review for earnings season so far, what kind of grade would you give it? I'll start with Gap.
B. At best. No, I guess I mean, there's a couple. How are we grading it? Are we grading it on a curve here, or because I mean, against expectations, I could go B minus. Overall, I would say a C plus. Is that fair? I mean, it hasn't been a great set of earnings by any stretch. Now, it was better than what we saw with the market on December 24th. I think that's certainly fair. So, but I mean, I'd have to double check the last numbers I was looking at. So this would have been from the S&P Global Market Intelligence, which would have been through the week of January 28th. 112 companies in the S&P had 500 reported. 70% had reported better than expected street expectations, but you've got to remember that the street expectations had been reined in a great amount over the last couple of weeks. The EPS surprise has been about plus 5.1%, which is generally in line with what we usually see. A little bit on the higher end there, but again, a lot of people have been slashing their expectations, and that's kind of what we've seen. We've seen weak earnings, but it's been better than probably an overly gloomy analyst community, which is always the case for there. The best growth that we've been seeing, energy and industrials and financials, we're seeing the best EPS growth. This was all pretty much expected, but so they're beating at the regular pace that they usually do beat, but you know, we just saw a lot of slashing of consensus estimates ahead of time, so they're just beating a lower bar, and we're seeing the better than feared reaction, but overall not a great round of results, and certainly the outlook has been conservative at best.
Well, the reason why I even asked that question is it doesn't sound to me like the type of scenario where you really want to be caught in that fear of missing out type trade and all the buying that we're seeing.
You're saying from the idea that people are buying this, and then when the data does turn, then we're going to see some additional.
Well, it's not like we got a robust. It's not like we're seeing robust outlooks. And I'll tell you, one of the things. Hopefully, you've noticed this too. But one of the things that I've noticed is we've seen earnings beats, but a lot of revenue misses. That seems to be a pretty common theme. That I don't like that when I'm looking at earnings. When I'm looking at the different companies, you know, I want to see earnings growth with revenue growth, and we're not. There's a lot of different times that I've seen that throughout the course, scanning through these earnings results, and to me that's somewhat troubling. I would not want to be involved in a fear of missing out type deal at all. So that's why I asked your overall relative opinion of where we are with this earnings season, and the picture you're painting doesn't sound all that robust. It makes me not want to jump in on the long side too much, I'll tell you that.
Yeah, no, exactly, and that's kind of why I've been looking a little bit for a fade. I've been saying, yeah, I think that we're in for a choppy 2019, where you're going to see bouts of POMO and FOMO running in, and then you're going to see. I mean, it seems to me, and you know, I don't really have the data to back me up, but with the growth of the robo trading and passive investing, that we've certainly seen a lot more extremes to the upside and downside over the last couple of years, and I'd be curious to see if that continues, because you know, a lot of this robotic trading just kind of builds off each other. It should hopefully, and that should give this service a benefit where we could take advantage of it. That's going to be our whole goal. And there's going to be, just because it's a choppy market doesn't mean that you just put your money in there and let it play. You try to fade the tops, you try to buy the bottoms, and that's our job here, to kind of really maximize people's product. You know, the money that you want to put to work for the most part here is going to be money that you're looking to be a little bit faster and looser for, and look for a higher rate of return, and that's what we're trying to provide. And you know, right now I just think we're kind of getting at a high-term bias, but again, that's why I brought back in those ideas that are really going to drag in on front order delivery. How do you put an order out when you don't know what kind of government you're going to be dealing with, where the key issues are going to be over the next year, where Congress is just going to be digging in their feet and willing to shut down the government for 5 weeks over $5 billion over a border wall that, you know, never would have been an issue a couple of years ago? How are you going to make any decisions around trade tariffs when there's always going to be that lingering issue going on? And I'm talking for like the bigger industrial plays, and there's a trickle-down effect there, and that's just going to lead to a lot of choppy activity throughout 2019. So that's what we're going to have to continue to kind of watch, and I think you're seeing that play out in the guidance.
All right. Any other themes that you guys are really focusing on before we wrap things up here? Is there anything that has really caught your attention, an edge that you found coming out of this earnings season so far?
I'll start with that. So again, I'm more of a see the forest through the trees type of analysis when it comes to the charting and aspects, and I'm always looking for that subsector or industry that's showing relative strength or relative weakness in context of the bigger market trends and momentum that are in place. And I want to really kind of hone in on those opportunities for potential swing trades, and kind of ride them for those breakouts, and as long as I can, as long as the momentum lasts during that cycle. And as of late, it seems to me like the leading groups, and again, I just talked about this an hour ago, how after strong, aggressive market corrections, typically what emerges are new leaders and new sectors to take the reins and lift the market into higher ground. And I'm seeing a lot of that recently emerge from the software arena, particularly as of late, we seem to have a lot of cybersecurity names emerging. I think we've mentioned this morning the one stock was Fortinet, was looking pretty solid on a turnaround, but there were other leaders that I have breaking out. Zscaler, ZS, ticker Zebra, SAM. Nice strong move here, $3 gain today, breaking out to new highs. There was a recent IPO just last year. CyberArk Software, CYBR, another one breaking out to new highs here today. So just you have a theme going on there. We mentioned solar stocks have been really strong here the last couple of weeks here, really aggressively moving higher here in a few names. If you take a look at the TAN, the TAN index is doing pretty well. A lot of industrials also seem to be leading the way higher. We had a really strong earnings response to, with Boeing as of late, but that's helping lift a lot of the aerospace and defense sectors, lifting strong here. So I'm just kind of honing in on a lot of things here. We have the ITB and the XHB, the home construction and home builders ETF, breaking out above 3-month resistance. They've been underperforming for months, and they seem to be turning a corner here. So there's a lot of different themes, coming out of a big aggressive market correction. Everything tends to stay in tandem initially when they make the initial recovery effort, but then here as earnings reports come out and the market kind of takes a little bit of a breather, to so to speak, you start to see these subsectors emerge as the true leaders, and I'm kind of focusing my attention more so on those. Initially I was more interested in financials and energy in the first half of January, and now I'm starting to see the shift go into some much stronger groups. So that's really where I stand right now on that approach.
So with that said, Blue Chip, are you looking for pullbacks to try to take advantage of? Because you're not going to be chasing something like TAN trading at its highs, right?
No, not at all. Yeah. So, and I'm not also going to short it either. I don't tend to short sectors because they run up too far too fast. But definitely on any sort of consolidation pullback, I'll start zoning in on the 60-minute time frame to see if there's an oversold RSI or stochastics to capitalize on a day trade of sorts. But I'm just highlighting relative strength and outperformance, where that basically tells me that there's institutional money flowing into these names, and when they do start to go through a little bit more of a pullback consolidation pattern, and everybody's else and most of the market's eyes go elsewhere, I want to scoop these things up, especially when they start showing signs of holding support, newly found support levels. So yeah.
All right. Anybody else with any type of themes? I know Chart Trader, you've already kind of dove into that over the last few days. We've had you on a lot, so you've really laid out your approach pretty well. Are there any other themes from that you've noticed? Scalp, maybe?
So I guess one of the things that I've really been paying attention to is some of the agency REITs. We have a position on an MORL, which is the 2 times long agency REIT ETF, and one of the key components, AGNC, reported earnings last night, and they had a really big decline in book value, which was somewhat expected. I think the reason, it sounds like boring stuff, but we're able to buy this MORL at almost a 30% yield, and so really I've been paying close attention to the quarterly numbers. So to make sure that we don't need to trim the position or get out. Right now we're up about 25% of that position, including dividends, and we own it at almost like a 30% yield. So it's been pretty compelling. The yield curve is really important to pay attention to. I listened to AG&C's conference call this morning, and they noted that they're increasing leverage just because they see a much better investment environment, especially with the Fed starting to move towards a dovish stance. So I think agency REITs might be able to work again here for maybe the next year or two, especially if rates are going to be at this level or potentially even lower. And they also tend to do really well during a recession. So I like this position, and especially like the income component from it.
All right, yeah, well, that's good stuff. That's something I wouldn't have on the radar if you didn't point out, because it's not necessarily the most sexiest of sectors and plays, but definitely all different ways to make money, and that's why we bring everyone on from time to time and get some ideas, pick your brains, and find out where we can put some money to work. So, gentlemen, I think... Oh, go ahead, Gav.
Just real quick to highlight on, to build up Damon's, that AMT, that's a REIT, that's at a 52-week high, and I just saw the IYR also at a 52-week high today. So that REIT section's definitely seeing a lot of bidding, as Damon was talking about.
All right. Well, I think we can wrap this one up. As always, gentlemen, thank you so much for joining us. I'll leave you guys on the line, so if you have any additional trades, feel free to jump on in and we can talk about it. But thank you for joining us. It's always a pleasure to have you guys on together.
Okay, talk to everybody soon.
All right. Thanks a lot, guys. I know there was a couple of questions on feedback that didn't necessarily pertain to our conversation, and one of them that I'll address right now is, let me find it again. Okay, this one comes from a futures trader and wants to know, does briefing offer trader audio for futures or trading information? So we don't do anything specific for futures trading per se. It's integrated with the trader audio service. I talk about the futures a lot. Chart Trader focuses majority of his trading on the futures market, and Event Trader, he dabbles in the indice, the index futures, the NASDAQ and the S&P futures. He'll do some in occasionally oil or the euro, the yen sometimes. So we do have a futures component, but not specific to just futures alone. It's all integrated. When you take a look at Commodity Trader, he will trade, as his namesake states, the commodity sector. So he's involved in natural gas. He usually trades ETFs though. So he doesn't necessarily go into the futures market, but he does trade the ETF equivalents quite a bit. So his focus will be UGAZ, UGAZ, and that's a 3-time leverage ETF for natural gas. He also does I forget the 3 times leveraged crude oil, but he does that. So you can participate in crude oil with Commodity Trader if you want to trade futures and adjust your risk accordingly, if you do so choose. But we do definitely have Chart Trader, Event Trader, who put on specific trades in the futures market, and Commodity Trader to some extent using the ETFs, but you could follow along with him on the future side if you choose. And then another one that I think is pretty relevant. We get this question kind of a lot, and the question is, I'm new to Briefing Trader. Is there any place on the website that explains how the traders size the positions both in and out, like for instance an entry of 1/2 size? How much is quote-unquote size?
Jim, I wanted to jump in on that one.
Oh yeah, please do.
I wasn't sure if that person was addressing me, because I tend to go, half scale in and out of positions, and so that half size sounds like it could be me. I've learned over the years that, oftentimes I'd say 50% or 40 to 50% of the time, I'm not right on the original entry, right? So you feel like, oh, this is a great entry. But maybe it's not, and you'll get a better entry in the next 20 to 30 minutes or next hour. So what I typically do is, when I feel like something is compelling and I need to get a position on, I start out half size, give myself enough room to scale into the position another half if necessary. And what I found over time is that that second half is the piece that I'd say 70-80% of the time makes money, and it allows me to start to take profits a little bit with a little bit larger size and a better overall price. So in terms of overall size, I think this is an interesting question because I know there's some different strategies or approaches to position sizing. I think, ever since I started trading about 20 years ago, I've kind of been comfortable kind of mentally with that around $30,000 to $40,000 total position size, so full size there. And for me, that allows me to, on a 10% move on a 40,000 position, that's $4,000. But I'm typically scaling out before I see 10% on an intraday basis. So if I'm scaling out at 5% on average, that's about a $2,000 trade for me. And that's, I kind of look at that as, that's the size that makes things worth my while and also doesn't cause me to stress out in terms of potential losses. So if I take a 10% loss on 40,000, that's a $4,000 loss. That's kind of my threshold of just kind of, not allowing the losses and the trade going against me to kind of start to cloud my judgment. So that's just a personal thing. I know a lot of people go with, percentage of asset size. So whether it's, 3% or 5%, for me, I've just figured out over the years that $30,000 or $40,000 position size is just that comfortable area for me on an intraday scalping basis.
All right, and what I would say as to it's really relative to the size of your account. So to have I thought it was going to be a tough answer because we don't know what everyone's account size is, and it may be a little bit different. In fact, some people may have a threshold of just a pain tolerance that says I want to risk $1,000 on this trade, or I only want to risk $500 on this trade, and it's really all relative to your account. So if a full-size position for somebody who has a smaller account and only wants to risk so much is 200, you have to scale it accordingly and know what the actual risk is. So it really is contingent on whether you want to do a portion of your account to allocate that amount of funds of your account, or if it's relative to the risk that you're associated in that particular trade. Time horizon, everything comes into play with that. It's all part of the equation. So you really have to assess what your own risk tolerance is before you enter the game, and then you can take half-size position to mean whatever you think it means. I would venture to guess that in the case of Gavin, when he says a half-size position, a lot of times it may be his level of conviction as opposed to a scaling in approach, because I don't think he scales in a whole lot, especially on some of the day trades. Is that a fair assessment, Gavin?
Yeah, I mean, if it's an intraday trade for the S&P, I'll look to just try to find that spot where I want to go in and generally do a half position from there. And, sometimes I will scale it, but it's very rare for me. And usually on the flip side of if it's an investment piece, I'll be a little bit more apt to scale in. Like, for instance, if I had a stronger conviction in Microsoft, that might be one where I'd maybe put in a quarter size piece here or something like that. But yeah, it's all about managing the risk, and that's usually, you can usually see my conviction in the size of the trade that I'm putting in. And I'll have different sizes too in terms of my investment piece, which is the bigger part of my portfolio. Then a swing piece, and then a day trade piece. And, the investment being the biggest, swing, middle, and intraday, that's usually like a quicker spec play that I might look at. So, I might have a little bit more of a risk tolerance on some of the smaller positions there because I'm looking for a little bit more bang for my buck. But how I'm always looking at it is risk reward. So, for instance, when I took that short earlier at 26.94 and a half size, what I was eyeing up was I risked 6, and was eyeing up 26.78. So as you can see, that was a 3-1 risk reward. That's generally what I'm looking at usually when I'm taking my futures trades. If I'm looking at a investment piece, or a swing, that's usually a little bit longer term horizon I'm looking for a nice little return on, and then the intraday piece I'd probably only be looking for a few points here that I think I could get here and there. But as Damon was saying, it's all about managing the risk more than anything, and that's what I try to do with my initial size positions.
All right, so good color from both you guys. I'm sure, hopefully the listener appreciates that one and can base his, because I believe it's a new trader. So I completely empathize with finding out what that comfort zone is, and it is a learning process. And we can try to help you out as best we can, but we can't pull the trigger for you. So.
Jim, can I jump in there one with
Absolutely.
So another component that I also incorporate in a lot of my swing trading, because I probably have a little bit more risk, I guess, because I tend to hold stocks for multiple days, so I become a little bit more subjective to analyst commentary and the general noise that happens in the market to sway it to and fro on a daily basis. But I also tend to incorporate volatility inside of all of my position sizing. So, for example, with data, Tableau software, DATA, the one thing I mentioned in my comment yesterday when I went long was that this is a low float stock with a daily range of about 4 to 5 points. And I think you can't ignore the vehicle that you're trading. This isn't something like a Verizon where there's just millions of shares trading and the daily range is about $1, or a GE or something like that. Data, DATA is definitely a mover, trades about only 1 million shares a day, and even if you don't have access to the ATR, the average true range, to determine how much the stock moves, just look at the range over the last couple of sessions, the highs and the lows, and you can basically come up with your own average of, hey, the stock actually moves probably somewhere in the range of 5 to 6 points a day. So from a swing trading perspective, you should really you try to time your entries right so you don't have to worry about risking a full $6 on a trade. You want to capture that momentum going on there, but at the same time you got to face reality and know that you have to give a stock enough wiggle room, because your timing, although it might look like you're timing the stock near perfect, when you decide to make that entry point, the reality is there's a whole day ahead of you and a whole other perspective going on in the market that you have to basically compensate for the ebb and flow, or the natural process of the market where it just goes up and down, and you got to adjust your risk accordingly based upon the inherent vehicles itself. Just to finally add on that, if you are new to the service, take a look at the archives. And search underneath the word style, S-T-Y-L-E, style ticker. This is basically going to bring up the details of each one of our traders and our styles. It's basically a guide to our approach to the markets, whether it's short-term, technical, fundamental, event-driven, what we like to trade, what the particular approach that we have, or what sectors we go after, and how we manage our risk, and what we're looking for in our risk-reward scenarios, and how we attack the market on a consistent basis. It's just a guideline. It's not a set-in-stone methodology. Of course, we're always adapting to market conditions, but if you're new to the service and you're trying to get familiar with each one of our names and what's going on and how what style best suits your own comfort level, definitely read through the style guide. It's a pretty quick read. It's not like a deep reading by any means. You could probably glance over all of our bios and how our guides in less than 10 minutes. But that will give you a really good sense. That's style, S-T-Y-L-E.
And can they just type in that in the trading ticker, Blue Chip?
Yeah, right in the archive search, right at the top right of your page. I mean, it should come up, S-T-Y-L-E. At least it did the last time.
Let's see, Blue Chip Style Guide.
There you go. And if you scroll down, you should see everybody else.
That is true. So on the Trader Audio Visual, I do have, you just type in style like he said, and there you go. You got Blue Chip Style Guide. Of course, if you've seen him dress, I don't know if you continue to read this.
Oh, please.
No, I'm just messing. Event Trader.
I don't have to go after your... Do you even have a wardrobe outside of jerseys?
Nope.
Yeah, I think so. Yeah.
I keep it simple. Yep, Commodity Trader.
As a mea culpa, I need to update mine, but...
What, your style?
God.
Or your fashion sense?
No, my fashion sense is impeccable.
I've actually complimented you a few times the last few months on your fashion sense, which either is really bad for me, or I don't know what that means. But you've had a couple of things. I think you've been a member of Stitch Fix, have you not?
No.
Okay. I heard somebody in the office talking about it a while back.
I'm just a member of the Polar Bear Club right now with the clothes I'm wearing and the weather out there, so...
Yeah, that cold is painful. I tell you, I went out to throw the garbage out last night, and it was like, yikes.
So, Gab, looks like we have some comments from
Carmine.
President Trump.
I was just talking with Carmine on the side on that, actually. So, just if people are looking for an update, Carmine, as you know, is our special situation political analyst here, and he follows us pretty closely and usually has a pretty good pulse on what's going on. So his thinking is that so Trump and Liu He are expected to meet at 2:30 p.m. Eastern time. That's about an hour and a half away. And then it sounds like there could be some sort of a press conference potentially. I don't want to get ahead of myself and say that, I'm sorry, that's 3:30 Eastern, I should say, so about 2.5 hours away here. Obviously 30 minutes before the close, so that should make for an interesting close. But he seems to think that the most likely scenario is that they will say that they're moving towards a deal, and that the hope is that Trump and Xi will announce that they plan on meeting sometime towards the end of February, probably, I would say. He doesn't want to say whether or not they would postpone that March 1 tariff deadline. Like I said, I don't think that the Trump administration wants to take that off the table just yet, so I'd be surprised to see him move on that. But if there was an announcement that Trump and Xi were going to set up a meeting in February, we already saw the positive impact that had around that G20 Buenos Aires meeting. So, that would be something that I think the market would see as a positive. But it doesn't seem like there's going to be really anything too meaningful coming from the announcements in terms of China buying this much soybeans or sorghum or anything along those lines. So we'll continue to follow this as it plays out. But next 2.5 hours, I think the market's going to certainly be closely paying attention to any headlines emanating from the White House.
All right. Well, it sounds like we got an exciting potential for some excitement over the next 3 hours until the close. So definitely keep us posted, Gab.
Will do.
All right.